Hello there, this is Dustin Jade Leone again with the 5 Keys Home Group coming at you from Denver, Colorado. In today's video, we're going to talk about credit. We're going to talk about the main factors that make your credit profile, and we're going to talk about the minimum credit needed to obtain a home loan. So we're going to make this video really short and simple. I don't like my videos going over about 10 minutes. So I'm just going to paraphrase and cover these topics quickly. So if I do forget anything, go ahead and leave a message in the comments below, and I will definitely cover whatever I missed in the next video. Before we get into it, I would like to ask all of you to please subscribe. And let's cover credit, the factors that build your credit profile. The first factor that we're going to discuss is revolving credit. Revolving credit is the credit that is renewed as debt is paid off. So credit such as your credit cards. And when we talk about credit cards, let's try to remember to use only 30% of your credit card limit and try to pay that 30% off or pay it back before the due date. Try to pay your balance back at least 2 to 3 days before your due date, because it takes a couple days to process. So if you pay the debt back right on your due date, by the time it's processed, it might be considered late. So our next factor is going to be debts and charge-offs. So debts and overdue balances can lead to charge-offs, which will negatively affect your credit score. So just finding out who and what you owe can definitely help you a lot, because once you find out who and what you owe, you can make a simple payment plan to pay that back. So you don't even have to pay the whole amount. You can pay minimum amounts and still watch an increase in your credit over time. So just say if you owe an old bank on a loan for $1,000 and you decide, well, I don't have $1,000 to pay them right now. You can just pay $50 right now, and then when the next credit cycle rolls over, you'll see your credit score go up a couple points because that debt has went down. So on and so forth. You can keep on paying them and doing it until the debt is paid in full. So just a nice little hint or trick to actually help you with that is using credit monitoring apps such as Credit Karma or Experian, Capital One's CreditWise. They will show you who it is that you owe in case it's from years ago and you don't remember. And then you can call those people up directly and make a payment plan and just pay them little by little until it's actually off of your credit profile. So our next topic is going to be the average length of all your credit accounts. So that's loans, credit cards, everything that's connected to your credit profile. What they do is they take the length and time of your oldest accounts and your newest accounts and they average them. And that itself makes a big factor of your credit profile, probably about 30% or more. So that means that if you continuously open new accounts all the time, just new one and new one and new one, your credit is going down because your average is getting shorter. So the longer you go without opening a new line of credit or a new loan, anything of that nature, the higher your credit score will be because the average is getting longer. So the next factor will be the amount of available credit that you have. So the amount of each and every individual card that you have will actually play a big role in your credit profile, but then the amount of all of your credit cards together as a whole make up 20 to 30% of your credit profile as well. So next we want to talk about a factor that is your inquiries. So an inquiry would be when you actually apply for something. Sometimes you'll see a letter in the mail saying that you are pre-approved for this or that, and that's when the company did a soft pull, which typically doesn't hurt your credit score that much, if any. But when you get that letter in the mail and you say, oh, I'm pre-approved for this or that, let me go and do the application, and then you actually click submit, then the company does a hard pull and actually checks your credit. and that would be considered the inquiry, and it will impact your score negatively. Probably only a few points. But then remember, the longer you go without applying for stuff, the higher your credit should be in that regard, because the old inquiries are now falling off from years ago. So with those factors, they build your overall credit profile. And now that we know what impacts your credit, we can talk about ways to get your credit up. So you can definitely get your credit up by just applying for, say, loans that you know you can pay off, and then just paying them off monthly at the actual minimum amount, or something above the minimum amount, not the whole thing. If you pay the whole loan back right away, your credit would only probably return to what it was before you got the loan. But if you actually pay it off piece by piece, you'll see your credit go up a couple points every single time you pay it off, a little by little. So that way, at the end, your credit will be a lot higher than if you paid it off all in full, all in one time. You could definitely open new credit cards and use them wisely. Again, only using 30% of your credit card. So just say if you have a $300 credit card, you can spend about $100 of that and then pay it back before the due date. That will definitely make your credit go up, and then it'll build a relationship with that creditor. So then they might send you offers for newer credit cards that actually get you cash back and points back and higher credit limits. And then once you start getting those credit cards, just having the higher limit in other credit cards will add to your overall amount of available credit, which will in turn make your credit score go higher. So now let's talk about the minimum credit needed for a home loan. And in most cases, the minimum credit score you will need to apply for a home loan will be a 580 credit score. But with the 580 credit score, you will most likely need to bring your own down payment, which with a 580 the credit score with the 580 credit score, the down payment you'll need to bring will probably be about 3.5%. So let's just say you have a $500,000 house that you want to purchase. The 3.5% down payment would be $17,500 that you would have to bring out of your own pocket. And because a lot of us don't have $17,500 just laying around, you might not be able to afford that down payment. So if you waited a little while and got your credit score up to about 620 or higher, you now may be able to qualify for down payment assistance or first-time homebuyers program, stuff like that, where a mortgage company will give you a second mortgage on top of the mortgage of the house, and that second mortgage would actually go towards your down payment. You can definitely talk to your mortgage lender about that further, and they'll have details for you about that. In most cases, the down payment might be forgiven after X amount of years of living in the home. And again, that's just something to talk with your mortgage lender about. So with all of that said, I just want to thank you guys for watching this video. If it was informational, definitely leave a like and please subscribe to the channel. I will always have more information on helpful things you can do to get a home loan and things that you can do even after you own the home. So if you are ever in the Denver metro area or in Colorado in general, and you are looking to buy or sell a home, you can always contact me, Dustin J. Leon, with the 5 Keys Home Group, based in Denver, Colorado. My website link is in this YouTube page, so if you ever need to contact me, or you want some info, or you want to inquire about something, just go to my website. The link is on the page, and you can contact me through email, Facebook, Instagram, Messenger, whatever you need. You guys have a good day, and I appreciate you taking the time to watch this video. I hope it helped you understand a little bit more of what makes your credit.